Welcome to Tech Talk Tuesday. I'm your host, Carla, and with me today is my fellow co-host and CMT, David Blake. It's Tuesday, April 9th, 2024, and we have some activity to talk about that happened in the stock market last week, along with some interesting things to look out going forward. We do it mostly from a technical perspective. David, I hope that you had a great weekend and Monday. How are you doing today?
I'm doing well, Carla. Thanks.
Great. Well, let's get started by looking at last week's market activity.
All right. Well, last week we kind of hit a rough patch in the market. Investors right now are struggling with some solid economic growth that's leading to higher rates. We see them ticking up basically every day here for the last week or so. And in fact, Monday, we actually hit the highest rate for the 10-year and 2-year since November. We backed off a little bit today, but we're kind of getting a lot of Fed members that, questioning whether or not we actually need a rate cut going forward or before the end of the year with this strong of economic data. And of course, what they're worried about is if the economy stays strong and then they start to cut, it starts getting too strong, and then we start reigniting inflation. And it's hard enough to slow down the first time without having it coming in a second time. That happened back in the 70s with Burns when he started to cut too soon, and then yield started to tick higher. And it took them about another year or so to get rates down. So that's what they're afraid of. We saw the 10-year Treasury actually touch 442.5 during the week, settled at 440, and the 2-year T-bill landed at 475. They've both ticked down just a hair this afternoon. Today we're off about 150 on the Dow Jones, and that has taken us Dow back down below its 50-day moving average. Last time we were trading below the 50 on the Dow was back in November. So basically the point here is that inflation is starting to get to the point where it's a little bit stickier than what the Fed wants. And it's kind of tying their hands as far as cutting rates because they can't cut and then have, be too soon and have inflation start to pick up again. So we'll have to see that. Now, one thing I did mention in the weekly letter last week, we saw crude oil prices go up above 87 a barrel. A lot of that is on geopolitical concerns, after the Israel bombed some of the Iranians in Syria. We saw oil prices go up. But we're also seeing, in general, we're seeing upward pressure on commodities in general, copper and everything. Commodities CRB index last week closed the week at its highest level since August 22. And that's going to put additional upward pressure on inflation, and the Feds can't ignore that. As prices for goods get higher for the manufacturers, they're going to pass that on to consumers. So we need to keep an eye on that. Okay, most of the sectors last week were lower, but one of the bright spots was energy. It actually hit an all-time high last week. It was up 3.89%. It was up yesterday again at another record high. We also saw communication services up last week. That was on strength in Meta Platforms, which hit a record high. And then we have Alphabet. Also it's had a good couple of weeks on their cloud stuff, and they're also been able to dodge some of these lawsuits that have been coming down. Staple on that. As far as the weak sectors, kind of the defensive sectors underperformed as yields go higher. Some of these like REITs and healthcare and consumer staples and utilities usually back off a little bit because they're not as attractive if you can get a decent yield out of a treasury and some tax breaks. So we're kind of keeping an eye on that. Consumer discretionary was also a big sector last week. Part of that was, again, part of the Tesla is a big contributor to that because they're coming out here and they're I think that last week or the week before they had their Chinese orders were down something like 30%, something like that. So they're struggling here. We did get a pickup in Tesla yesterday, about a 4.9% jump. That was on top. They're recommitting to something to the robo taxi services and also to AI. So that's trying to bounce a little bit more. I know that Kathy Woods has been buying a lot of Tesla again. That's one of her top positions. She's been picking up here in the last couple of weeks. So, but then in general, last week we had investors were a little bit whipsawed especially towards the end of the week, we actually saw the VIX, the volatility index, jump up 1635. I think it closed on Thursday. That was the highest since the first week of November. So the traders are beginning to get a little bit nervous with the rates picking up here, and the fact that we're talking about keeping rates higher for longer. And I think if the longer they keep rates up, then you're going to start getting more people suggesting that maybe we're not going to have a soft landing. They'll start talking about a recession again. But for the week, Dow finally had a 2.3% loss. I think that was the biggest loss in a week since March of last year. And then the small cap Russell was also down about 1.87%. So it's been struggling. And the NASDAQ, I think, has been down for the last 5 weeks. So if you look at the chart on that, it's been going sideways. You're getting these dips in here, but it's we got a little bit of a case where you bend but not break.
Okay, and how is the technical condition of the market doing?
As far as the technical condition of the market goes, it's still positive, but again, we're kind of struggling to get any higher here, with yields going up and also commodity prices going up. Both of those will usually weigh on equities. So until they kind of start to flatten out or move lower, you're going to see equities struggle here a little bit. MACD, which is kind of a short-term trend gauge, it's in negative ground for the different indexes. That's not a sell signal by any means, but it's just kind of showing you that we are drifting sideways to lower.
How's the 14-day RSI doing, and what does that tell us?
Momentum is still positive, but you can see in the 14-day RSI especially, it's been slowing. I don't see a lot of negative divergence in that. That's usually one of the indicators we look at for negative divergence. I don't really see that yet where you're thinking, I think this is, we may be getting close to a sell signal. So we'll watch that. I mentioned that Dow Jones did slide below the 50-day moving average last week. That was, caught some traders' eye. In addition, we also saw the Dow, when it pulled down here around this 38.6 area, that happens to be a 50% retracement level off of the January low to the March-April high. So that would be a space where you, if you're Fibonacci guy, you would take note of that as a likely place that you would want to see the Dow find support. I think if we break down below 38.6 with a little bit of momentum behind it, you're probably looking at this thing going down to about 37.8, 37.9 for kind of a quick bolt lower. So you kind of want to watch that. The zigzag that we had last week, the big spike up and the big spike down on Thursday, where the Dow actually lost 500 some points. Again, it's with whipsawing investors. I just mentioned that the VIX went up to 1635. Usually around above 15, you start to see if the market is going to hold or not. Because at 16, you're thinking, okay, we're real close. This is, you're going to catch here, and maybe we can start to rebound. But if it starts to go a little bit higher, it may induce a little bit more selling. I would keep an eye on that. If we do break that 38.6 area and start heading down closer to 38,000, you might see the VIX get up around the 20, 21 level, and around 24, 25. That's usually a pretty good sign that as long as you're still in in an uptrend, you could probably jump in there and start nibbling away at positions. So kind of keep that in mind, especially tomorrow if you start to see the market roll over there.
And how is the underlying market breadth doing?
As far as breadth goes, it's just not bad. The Friday before this last Friday, we actually saw the NYSE hit a new high. We look at that as a leading indicator of market direction. If the AD line is going up, that usually means that most stocks are under accumulation, and the trend, the rally should continue. So we'll kind of keep an eye on that. Yesterday we were positive on the AD line. We're not at a new high. We're still only about 1,500, 2,000 units off of the all-time high. So that's not a worry yet. We'll keep an eye on that. If you would get like 3 or 4 days where you start to see the AD line, when you look at the market recap, fall below, say, 528, 529,000, you would want to maybe take a notice of that.
And how are we looking for investor sentiment?
Investor sentiment actually is still overly bullish. The bullish investors hit a 3-year high at 62.5%. The spread between the bulls and the bears, because the bears are now down to 14.1. That's the biggest spread between the two groups since April of 2020. So it's hard to find a bear in this environment. That will probably change once they start talking about pushing out rate cuts further into the year. We've had some questions about the CTI, and again, the CTI, when you talk about a forecasting tool, it has worked. It's been around for years. We've been actively using it since, I believe, 1990, at actually daily use, and occasionally you just get out of sync. And there's other, the Hurst cycles are used on some other websites and that, and I can, as long as I've been doing this since 1997 working with the cycles, I don't think I've seen this much confusion in the different followers of cycles. You get on for a while, then you're off. The pandemic caused part of that. You don't know whether that was the end of a 9-year, 4-year cycle, or whether that was a fundamental event that Hurst talks about that could come in. And if you have something like that, where a war starts, where the market goes down 5,000 points and then bounces back, those fundamental events sometimes aren't the end of a cycle. So right now we're watching things. It's possible that last Friday could have been the end of some of the cycles. That you have to wait for a couple of weeks so these things play out until you can say, okay, that was definitely, say, the 18-week or the 36-month cycle bottom. And as soon as we decide on something here, we'll get it in the letter to see how that is. But we see momentum index slowed down to a 4. We're still, we're just kind of going sideways here when you look at the chart. We need a little bit more information. The big debate here is going to be, is the Fed going to cut rates later on in the year in June or September? That's what has triggered a lot of this rally to go higher since the first of the year. And now when you start saying, well, are we going to cut rates, or maybe we're going to go September, October? Well, of course, that's going to stall the rally until we can get, a little better picture of what's going on. Because, if you remember in January, some of these crazies on Wall Street were talking about 5 or 6 rate cuts. We didn't believe it here, but we thought maybe 3 might be appropriate. We'll have to see. The Fed, as far as their last FOMC meeting, they kind of hinted around that they still had 3 rate cuts on the table. As of right now, I think tomorrow is going to be a market mover. The job rates, the job info keeps coming in strong. We start with the earnings. We'll see whether earnings can continue to beat estimates. I think for the fourth quarter, I think it was something like 71% of the companies reporting in the S&P 500 beat the estimates, which is a little bit better than normal. Of course, going into the fourth quarter, a lot of people thought that we'd be starting to be talking about the economy going to recession in 2024, but that doesn't look to be happening right now. So a lot of stuff going on with this much of a rally. I don't think it's something you chase, but when you see something fall down, where you're looking at something that looks cheap, you've been thinking about buying it. If you wanted to buy, say, 400 shares of something, and you get maybe a day where the Dow falls down, where it comes back around to its 50-day, or maybe we get the S&P 500 starting to test its 50-day moving average. Maybe you pick up 100 shares and you kind of play this, as it goes. You don't just jump in when you have a market like this, and that would allow you to, maybe you buy some at 40, maybe you buy some at 36. Then you buy some more at, say, 30 or 39 as it bottoms and heads back up, and that way you dollar cost average, and you don't just buy something and go down $5-6 right off the bat. So be a little bit cautious in here. We're getting conflicting signals from left and right. When that happens, it doesn't necessarily mean that you need to sell everything and go to the sidelines, but just makes you want to be a little bit more cautious until you can get an actual read on what it looks like going forward, especially this year with the rate cuts, because that's triggered a lot of the gains. You want to see how that's going to play out here, and just be cautious here. April is generally one of the best months of the year for the market. We have that working for us, but then don't forget, After April comes that May, and you get the old Wall Street adage where you sell in May and go away. And we'll have to see whether that's going to play out this year or not.
One of the things that stood out to me the most this week, and you mentioned it a little bit earlier, was the MACD crossover. Can you elaborate on the importance of this technical event?
Well, we look at two MACDs in there. We have a short term and a long term. The short term MACD, I don't consider that much of a signal at all. That might be something where if you're looking to buy something and the market's been kind of going sideways, and you look at the short term MACD, which is I believe the 924.19, I think. I'm not sure the numbers on them right now, but that might be something where, okay, it crossed over to a bearish read. That probably means you wait to see if you're going to get a little better entry point. The longer term MACD is one where I think that gives a more reliable signal for investors. When you see the longer term MACD, these are exponential moving averages that they're based off. That gives a little bit better signal for longer term investors, not short term investors. But when you see like Apple, gave an MACD, went negative, about a month or so ago, 6 weeks ago, and the stock's done nothing since then. If you're looking to buy Apple, that would be one indicator that you could put on there to see as it's going down sideways to down. When you see the longer term MACD give a bullish cross, that's a signal that is going to be more reliable for that. And as far as short term trades go, though, on the short term MACD, I don't consider that a very good trading signal at all. That's just something to know that if you're thinking about buying something and it crosses into bearish territory, you might just watch it here a few days to see what the stock's going to do. That usually means that there's some weakness. You might want to check the up-down slope to go along with that, and also momentum, maybe a shorter term momentum, 4-day or 3-day or something like that, or 9-day. But just as far as say, okay, we got a bullish cross to the short-term MACD, I'm going to buy. I don't consider that a good, reliable signal.
Got it. Okay, and then I'm assuming that we saw the short-term MACD crossover last week and not the long-term MACD crossover.
In the market, go ahead and pull up go up the charts and pull up SPY.
All right.
Okay, go on the bottom there. Do you see, we have the MACD up on this? No, go ahead and pull the MACD up. There you go. And this one is the short-term MACD, and it actually went to, as you can see, actually going back to about March. That MACD thing has been kind of buy, sell, buy, sell, buy, sell, buy, sell. You have like 3 up days and it gives a buy, then you have like 2 down days, it gives a sell. But it goes up 3 days, it gives you a buy, then it rolls over. So you can see that that's not a signal. If you had been buying and selling on that thing, you'd have been whipsawed left and right all over the place. So right now, you're getting a little bit more of a separation in that. So on the SPY, you had that big down day from last Thursday, and that was almost something was that candlestick, that bearish engulfing candlestick, was more of a sell signal than what the MACD would be. But you did get the MACD crossing negative. You want to kind of keep an eye on that and see how it goes. As it starts to spread, it gives a little bit more of a you can then start to see that the trend is beginning. But when it's going sideways like this, for short-term trades, as you go back there again to about March, it doesn't really give you any reliable, whether the market's bullish or bearish. Going back is just basically just going sideways, and that you can't work off of that. Go back there in October where you see the thing give a nice cross, and they stayed separated for quite a while. That's that. When you get that, then you can stay with the trend and ride that out for a little while. You can jump in if you're thinking about buying, like last October, November, and the MACD was remaining bullish. that's the okay signal. But it's just when you get these sideways things like you have, that you look at the chart, 3 days up through 2 days down through 4 days up, 1 day down. That's just not a short-term trading signal that you're gonna make money on. You're gonna get whipsawed and be stopped out or stop in or whatever, almost daily. So I would ignore that until we see the separation between the two signal lines.
All right, that is extremely helpful. And then you mentioned a bearish engulfing candlestick. Is that this one right here?
Yeah, that's when you have with the day before that Wednesday. You see the candlestick there. And then that Thursday, you have the big red bar that we were higher, and the market opened up higher and finished lower than the day before. It has engulfed the day before. It's a more reliable signal when that the day before is a little bit bigger than what that one is. But that just means that when you have a candlestick like that, that means that the bulls tried to take it higher in the morning. Then the bears took over and they eliminated the bulls up there at the top, and they took control of the market that day, and they finished it down on the lows of the day. That's a pretty bearish signal. That means, especially when you cross below a 50-day moving average to boot. I was kind of surprised that we bounced back on Friday. Part of that was on the jobs report that the wage growth was kind of in line. Had we gotten wage growth ticking a little bit higher, I think you probably would have seen a continuation of that Thursday selling. But it was enough that, combined with hopes for a rate cut, you got that little bit of a bounce back. Now today, again, you've got the Dow crossing below the 50-day moving. This blue line, I'm sorry, is a 21-day moving average. But on the DIA, if you put that up, you can see that it was a 50-day that was crossed below.
I'll take a quick look at that one.
Okay, there you can see that the gold line there is the 50-day moving average, and we came up there. Now we're actually just kind of bouncing up against that 50-day moving average, and that's kind of telling you with the VIX a little bit higher that traders are looking at this, and they're kind of, you're going to need a pretty good day here on the Dow for this thing to turn around and start getting some positive momentum going above. Now today, again, we're falling back below that 50-day moving average, and if you put the cursor on there, you're going to be right around that 386 at the bottom there, and that's, you go back there, you tested that to the left 1, 2, 3, 4. There four times back in February and March. That 38.6 was no, go to the right again, to the right. You're right around in there. You saw that 38.6 was again a place where the market came down and kind of held in there, and we bounced it back. If we break through that, I think that's going to probably induce more selling, and that should take us down to that 37.6, 37.8, somewhere in that area. I don't have it in front of me right now. I should have, but I think, again, keep riding that 38.6. We break below that, you're going to probably have more selling, and that'll probably what'll cause that will be rates ticking up closer to they get about 445, 450. You can see the 10-year go up to the 460. That's a target on that, which would not be healthy for equities.
Okay, that is extremely helpful to know. And I actually, if you have MarketEdge, you can add BIA to your stock watch list, which I already have. So I get nightly email updates on that as well. So, all right. Well, David, thank you for all of the very helpful information. We have a lot of things that we can keep track of here going forward into the week. We do have to wrap up this week's Tech Talk Tuesday. But we want to thank you to all of our listeners. Be sure to subscribe so you don't miss any of our future episodes. Thank you for listening, and we will catch you guys all next week.